Hello everybody, in this video we are going to discuss about the cash flow statement. So statement of cash flow in the year 7. This topic we are now discussing. First of all, what is mean by state flow of cash flow? So cash flows means it is the 1 year statement which provides the details about how the cash is generating and how the entity is applied by the entity during the period. These are the topics will be there in the cash flow statement. Now, this cash flow statement further classified into three categories. One is relating to cash flow from operating activity, and another one is cash flow from investing activity, and another one is cash flow from financing activity. Now, these are the cash flows where operating activity includes cash flows which are come from the principal revenue generating activity, that is activities which are not a investing or which are not a financing activity will be included in the operating activity, whereas cash flow from investing activities include these are the cash flows where you can sell or you can buy the long-term nature of assets like property, plant and equipment, intangible assets or investment, etc. These are the transactions will be come under the cash flow from investing activity, whereas cash flow from financing activity, here the entity whatever the cash flow from issuing or redemption of equity and the borrowings, the nature of this activity will change the entity's nature, that is the come under the financing activity. These are classifications. Now you need to prepare the cash flow statement at the end of the year. So for statement of cash flow preparation we have two methods. So first method will be direct method and second method will be indirect method. Direct method, here the statement of cash flows will calculate the amounts whatever the cash flows from operating activity, cash flow from investing activity, cash flow from financing activity. Firstly, the operating activity will be considered. In operating activity, whatever the cash received from the debtors or whatever the cash paid from the paid to creditors, whatever the amount paid for the operating expenses. Operating expenses means here to run our business, whatever the expenditure incurred by the entity will come under this head. Now, if for example, if the entity is paying any salaries, if the entity is paying any wages, if the entity is paying any payroll or administration or selling expenses, what overheads, insurance, whatever the expenditure they are incurring for to run the business, to operating the business, this will come under the operating activity, and the entity income tax paid relating amount, the business profits tax will be considered in operating activity. If it is related to asset tax, then it will come under the investing activity. Next, we need to deduct or additions of the exceptional items or extraordinary items which are in not in the nature of regular course of business. This will come under later. Next, net cash flow from operating activity. This is the first head. Next, cash flow from investing activity. In cash flow from investing activity, we will consider whatever the cash received from sale of property, plant and equipment, intangible assets or investment property, or whatever the cash paid for the purchase of property, plant and equipment or intangible assets or investment properties. Or if you are receiving any interest or if you are receiving any dividends, then it will also come under the investing activity. Now if you are paying any income tax relating to assets, if you are selling any immovable property, then it may raise the capital gain. So that type of capital gain will come under the head of income from investing activity, does not come under the operating activity. Next, third category will be income cash flow from financing activity. What is there in cash flow from financing activity? Whatever the cash received for issue of share capital or debentures or loans will come under the financing activity. Or if you are cash paid for redemption of share capital or debentures or loans, then it will come under the here. The main part here is if you are paying the interest, or if you are paying any dividend, come under the financing activity. If you are receiving the interest or if you are receiving the dividend, it will come under the investing activity. And this adjustment will need to deduct from the operating activity, because it will be there in the that operating portion. Now at the end of the statement, we will get the opening balance of cash and cash flow equivalent, and we will get closing balance of cash and cash equivalent. This is direct method. If it is a indirect method, the statement of cash flow, whatever the three categories: operating, investing, financing, the investing portion and the financing portion remain the same. The changes will come in operating activity. Here, profits after tax, as for the profit and loss account, or we need to add back the tax amount charged in the profit and loss account, and we will get the profit before tax as per the profit and loss account. Now we need to adjust some adjustment entries. That adjustment entries will be the non-cash expenses like amortization, depreciation or impairment losses, or we need to add or deduct the non-operating items, like if it is the investing activity or if it is in financing activity. If you are dividend paid or interest paid, it will come under the financing activity, so we need to deduct here, and we need to add back here, and we need to deduct from the financing activity. If you are dividend received or if you are dividend interest paid, then we will be add back here, and we will, if you are receiving that, it will come under the investing activity. That type of adjustment we need to do. And if you are sell any property, plant and equipment, the loss will be shown in the profit and loss account debit side, so we need to add back here and adjust to the investing activity. And if there is exchange gains or exchange losses relating to investing or financing activity, we need to add back here and adjust in the respective heads. Or if it is the exchange loss relating to bank balance, Indian foreign currency, we need to add or less here. Now after that, we need to adjust the relating to operating assets. Here the simple formula for the operating assets, if the asset is increasing, there is direct relationship. If the asset is increasing, there is indirect relationship, so we need to deduct. If the operating asset is decreasing, then we need to add. If the relating to operating liability, the operating liability is increasing, we need to deduct, add. If the operating liability is decreasing, we need to deduct. So for the operating asset, it will be indirect relationship, and operating liability, it will be direct relationship. And after that, we need to deduct the income tax paid in cash. Will not adjust the entry relating to operating activities. Here we need to consider only tax on business profits, does not consider the relating to assets profits. Now after that, we need to adjust the exceptional items. Exceptional items are extraordinary items, like if your entity is received any fire insurance claims or any other insurance, that are exceptional items which are not in the regular course of business, will adjust here. Net cash flow from operating activity remain the same. The cash flow from investing activity or cash flow from financing activity, just we need to see the amounts interest received or in dividend received, this will come under investing activity, and respective tax of the long-term nature assets will come under the investing activity. And the cash flow from financing activity, whatever the share capital amount, redemptions, issues, if you are paying interest paid or dividend paid, come under the financing activity. Now if you are paying any income tax relating to financing related items, then it will be considered here itself. After that, we will get the net cash flow from all activities. Net, we need to add back the opening balance, we will get the closing balance. Now here we need to remember, for the purpose of calculation, the direct method. In direct method, we will take the whatever the amount received from the cash received from the debtor, cash paid to creditor. So for that, we need to prepare the their ledger account. If the we are calculating the debtors account. Debtors account means debtors account always have the debit balance. So opening balance is debit, closing balance is credit, and the amount if you are they will provide the in question sales they will provide, so it will come under the debit side. The balancing figure, whatever the balancing figure, the cash or bank balance, it will be taken into the operating activity, that is debtors account. Or if we are preparing the creditor account, for the purpose of creditor account we need to take that the creditor account will be there in credit balance. So opening will be credit side and closing will be debit side, and the whatever the purchase they will provide the purchase details. So in here the purchase they will not provide the direct purchase in some cases. For that we need to take the purchase is equal to cost of goods sold, whatever the cost of goods sold or cost of sales, we need to deduct the opening stock and add back to closing, we will get the purchase. So we will show that purchase in the credit side of the creditors ledger account, then we will get the bank balance or cash balance balancing figure amount. This will be taken into operating activity. This is direct method. Whereas non-cash transactions, we need to exclude the statement from cash flow. So, for example, if the entity is purchasing one building and exchanging another asset to that entity, then it is nature of non-cash item which will not consider anywhere of the cash flow statement. Or if the cash flow statement should not provide the net basis, so we should not adjust the same nature even if there is a same nature. For example, if your commission is receiving or if your commission is paying, we should not show that commission received, commission paid on net basis. We need to show that commission received in separate, commission paid in separate. If you are receiving interest received, interest paid, we should not show in a net balance, we should show in a different. If it is interest paid will come in the financing activity, if the interest received is come under the investing activity. The net amount is not allowable. Next, if the cash flow statements, after that whatever the activity, the three activities last, we will consider the cash and cash equivalents. What comes in the cash and cash equivalent? Cash means you know already the whatever the amount is there in your hand, that is cash in hand, or cash balance, that is cash balance. Plus we need to add the bank balance, it also come under the cash in hand only. And we need to add back the relating to if you have any investment, that the investment having the maturity of 3 months or which is less from the acquisition date, which does not have the much risk, then it will be come under the, here we need to add back. And we need to deduct the bank overdraft. Bank overdraft also cash related. Next, if you are preparing consolidated financial statement, then for the consolidated statement you need to prepare consolidated cash flow statement. So consolidated cash flow statement, for that consolidated cash flow statement we need to consider consolidated balance sheet and consolidated profit and loss account. So for the applying same, whatever the we are discussed up to now we will consider same, but the new items means new adjustments will come when we are preparing consolidated financial statement. In operating activity, adjustment entries will be the share of profit or loss from the associate, we need to adjust this entry. If it is a share in loss of associate, we need to add back, or if it is a share in profit of associate company, we need to deduct. Next, if it is a in cash flow from investing activity, then if you are paid cash paid to acquire the subsidiary company, then the cash consideration, whatever the cash consideration we are paying, from that we need to deduct the amount which is there in that subsidiary book, means cash balance available in the subsidiary company, we need to deduct that amount from the whatever the consideration we are paid. Next, minus we need to adjust the cash paid for investment in associate company. Next, if the subsidiary company is acquired during the year, then we need to add the assets and liabilities acquired from subsidiary company to opening balance of assets and liabilities in the consolidated balance sheet for the purpose of calculation of cash flow. Now, after completion of cash flow statement, we need to reconcile the statement with foreign currency. If you are having functional currency and foreign currency is different, then we need to adjust that. We need to reconcile that foreign currency cash flows. So for that cash flows in foreign currency, we need to convert it into functional currency, which we need to use the exchange rate at the date of transaction. So at the date of transaction, whatever the exchange rate is there, that exchange rate we need to consider here. In next, if exchange gain or loss arising on bank balance which is held in foreign currency, we need to be add or deduct from opening balance of cash and cash equivalent, because we need to reconcile the closing balance of cash and cash equivalent in the statement of cash flow in the balance sheet. So for that reconciliation, we need to add or deduct this bank balance held in foreign currency. Exchange gain or loss. Now, it's all are same for all entities. If the entity is there in a financial institution like banks, NBFC, etc., then the cash flow will be some items, whatever the specific special focus maintained in the operating, financing, or investing, or mainly operating. The special focus items will come under the operating items in the financial institutions. For example, if you are loan given to customers, that will be come under the operating activity. But or loan repaid by the customer come under the operating activity. If the same two items normal business, it will come under the financing activity. Or if your deposit accepted or repaid, or if your interest received or paid, or the amounts, if the interest or dividend is received, come under the operating activity. If your interest paid, it will come under the operating activity. These all are financial institutions, their operating nature, so that they will come under the operating activity. If dividend is paid, will always form part of the financing activity for financial institution also. Now, and whatever the methods, the two methods we are discussed, one is direct method and another one is indirect method. The entities are encouraged to follow direct method, because the direct method will provide the cash flows of the entity, so it will useful for to take the decisions. So for using that, by using that cash flows, we can calculate the NPV. So if the NPV is positive, we will take the project. If the NPV is negative, we will take the project. So for the decision making, it is useful when we are using the direct method. It is related to cash flow statement.